In the early 1600s, Dutch East India Company employed hundreds of ships to trade gold, silk, and other commodities all around the world. Now see, the company knew that there was many other untapped markets that it hadn't yet traveled to, and all of its current boats were out on expeditions. So looking to expand the business quicker, they turned to the public for money, and in exchange they'd give them a percentage of the money they make back from the shipment. With all this new capital, the Dutch East India Company was able to employ even more ships and grander expeditions to further lands, increasing their revenue to exponential rates that they could never reach without this capital. And this did two things: it made them rich and it made their investors rich, unknowingly creating the first share exchange. And it hasn't really changed today. I thought it is important that you know that story because the stock market exists for two purposes. Purpose one is to allow good companies to raise a large amount of capital from the public without giving control to a private investor or taking on too much of a financial burden paying down a loan. And reason two is it allows owners that don't want to be part of the company anymore to sell out of their share, no longer owning the company in exchange for a boatload of money. So is investing gambling? Well, it can be. See, if you're investing in the short term, then obviously it's gambling, because no one can predict a market or a stock within the next 5 minutes, even day, even week probably. And the reason for that is market factors can change, like material prices, labor costs, or current technology. Or other investors might change their mind about the stock because of some publicity or leadership changes or some new laws or trade policies. And all of these factors can result in huge panic sells that can create huge fluctuations in the market for really no reason that you would never be able to predict from the future. However, if you're investing in something because you believe it'll do good in the future and it's a solid company, and you're willing to hold through all that market fluctuations, and for a long time, 5 to 10 years down the road, you believe the company will be worth a lot more than it is currently, then no, it's obviously not gambling. See, here's the problem why people think that stocks are gambling. Now, a lot of people that don't really invest in the stock market, they say, oh, I'm not going to invest because it's all gambling and someone has to win, someone has to lose. It's just like crypto, blah, blah, blah. But you have no clue what you're talking about. If you hear anyone talking like that, send them this video. See, when a company puts out stocks or they launch their IPO, initial public offering, which is when you launch your company onto a stock market like the ASX for Australia or the Dow Jones in the US, they're doing it for a reason, okay? And they teach this in like business class in high school. Some CEO with his masters or doctorates in business isn't just gonna sell a percentage of their company for no reason. So this is how stocks work from a business's side. Now, I'm a mining company and I want to buy a big new mine or a facility or something like that, and it costs $1 million. Now, I don't want to go to a private investor for whatever reason. I don't want to pay interest. Maybe they're wanting some sort of control over the company that I don't want to give them. So I'm going to put out my stocks and sell 1 million shares to the public for $1. Now, let's say I believe my business is worth $10 million currently, so that'll be worth 10% of my company that I'm willing to give up to have this new facility, because I believe that facility will make me more money and expand my business by, let's say, 2 times. So now my business is worth $20 million. So I've given up 10% of my business, which is worth now $2 million. But I've now made $8 million because I was able to expand using this new capital. And now I can either give my shareholders some profit back in the form of dividends if I have a lot of cash flow, or the market will correct itself because now this company is worth $20 million and the share price is lower than what that company would be worth. So then more people buy and the share price increases. And both those outcomes result in the people that bought the shares initially profiting because the company became a better company. So as you can see, it's not just like buying cryptocurrency where there's no exchange in value. There's an actual exchange in value in the stock market, and that's why it's not gambling. Well, this is all great and all, but how long do I actually have to hold an investment for it to be 100% sure that it's going to be doing the right thing that I want it to? Now, if you're stock picking and investing in individual companies, there's really no answer for this, but it's probably pretty similar to how you would invest in a market. And how is that, you ask? Well, I'm about to tell you. Well, between 1928 and 2021, the S&P 500 returned a positive investment 73% of those years and a negative return 27% of those years. So what does that actually mean? That means that if I hold my money in the S&P 500 for 1 year, there's currently a 73% chance of it returning a positive investment. Now, this is all based on past history and past averages, so it's not guaranteed to be the same in the future. But if I hold my money in the S&P for 5 years, On average, it would return a positive return 87% of the time and a negative investment 13% of the time. If I was to hold my money in there for 10 years, 93% of the time I would receive a positive return. And if I hold my money in the S&P 500 for 20 years and any time since 1928, it would be 100% chance of a positive investment. So if you're going based purely on past averages, if you want a 100% certain safe investment that is going to make you money, then you would have to hold your money for 20 years in a broad index fund. Now, it's not going to give you an incredible return. If you want an incredible return, then you have to take a little bit more risk. But if you want a safe investment, then you got to do what you got to do. And it just shows that you really just have to trust that the stock market was built for a purpose and have diamond hands, okay? We don't want any wooden or silver hands. You don't drop it. You don't fumble the bag. Now, when it comes to investing being gambling, or if it's more tactical and actually investing in something because you're providing value to the company and they're providing value to society, which in turn is going to create actual money, that's what you have to focus on. Does this company provide a value to society that will become profitable in the future? If you're investing in some small tech company that doesn't actually do anything right now that might produce value, then it has huge potential, but it's gambling because you don't know if it's going to do that. It could, yeah, it could, but it also could not. But if you're investing in a huge company like Wesfarmers, a mining company that's been going on forever and is going to provide ores right now and into the future, then you know it's probably a safe investment because they're not going anywhere. They're going to continue to make revenue, which is going to allow them to build their brand reputation, which is going to increase their stock price because more people are going to want to buy them. It's going to allow them to give back some of their revenue and profits to their shareholders in the form of dividends. Now, when it comes to dividends, again, it's much more of a cultural thing depending on which country you are in. For example, Australian stocks normally give really high dividends, where US stocks don't really give a lot of dividends for some reason because their price explodes, and a lot of the time they invest back into their own stock, which will increase the price, but it won't pay out a dividend. I've heard people say that's because like big tech giants like having their ego a little bit inflated. Like Jeff Bezos is the richest man in the world. He wouldn't be that if they didn't invest some of their profits back into the stock. But that's a tangent for another day. If we're talking about dividends, then a lot of the time your stock doesn't really have to increase too much in price if they're giving out a good dividend. So for example, Wesfarmers, an Australian mining company that I was talking about, they give out like a 5 to 10% dividend just depending on how profitable they are in the year. And because they have a huge market cap and their market isn't really expanding too much because they're already so big in Australia, their stock price might only increase 1 to 2% every couple years, but they're giving out 8 to 10% dividends, so you don't really need the stock price to increase and you just make money off the dividends. So you're not gambling there either. You're just holding a stock that's paying you a little bit of money, and over time, over 20 years, it'll pay you like 160%, and that's with the dividends not reinvested. So if you reinvest the dividends, it's a lot more. But either way, guys, I hope you guys enjoy the video. Let me know what you guys think, and I'm out. See ya.